Hey everyone, it's Owen. This is a special announcement. Together with Andrew Page and our friends at Strawman, the Rask team and I are hosting an investors event in Melbourne within the next month. As you'll hear in this episode, networking with other investors is a great way to learn and share ideas. So come to meet me and guests from this series to talk about investing, share ideas, and build a network of like-minded investors. The event is open to investors of all stripes and experience, but there are only 50 tickets remaining, so reserve a seat for you and a friend by visiting the Rask Finance website. And if you're in another Aussie city, send us an email or tweet to us to let us know that you want an event closer to you. I look forward to meeting you in person. Hello, and thanks for tuning in to the Australian Investors Podcast, a series exploring the investment philosophies and journeys of some of Australia's leading investors and financial thinkers. I'm Owen Raszkiewicz, founder of the Rask Group. For show notes and other episodes in this series, as well as free educational resources, please visit www.raskfinance.com. Before we go on, it's important to remember the Australian Investors Podcast is provided for educational purposes only and should not be relied upon to make an investment, financial, or taxation decision. The information included in this podcast does not take into account your needs, goals, or objectives, and guests appearing on the show may have a financial interest in some of the products mentioned. Please read all the important disclosure documents and refer to the Rask Group's Financial Services Guide on the Rask Finance website. My guest for this episode is Curtis Larson, a private investor and portfolio manager for Norse Capital. Curtis is open and extremely generous with his time, making this one of the easiest and most relaxed conversations of the series thus far. But don't let that fool you. This chat is filled with nuggets of timeless wisdom gained over a career spanning more than 2 decades. Curtis grew up in Asia, trained as a computer engineer in Canada, worked for companies based in London, Paris and Tokyo, but now he resides in Sydney. A graduate of the prestigious Yale University, Curtis and I discuss his time growing up in a family that didn't talk much about money, his various jobs, successes and failures, and investment strategy. Curtis spent time in investment banking designing quant models and trading options. As with some prior episodes, we try to keep the ideas as informative as possible, but if you find yourself a little lost, I encourage you to listen again or take our free video courses on the Rask Finance website. Alternatively, reach out to me with any questions you may have. Curtis believes it is vital for self-directed investors to ask themselves if they have the temperament, inclination, and time to invest money on their own behalf. As usual, we start the discussion with Curtis's early life. Okay, Curtis, thank you for joining me.
Happy to be here.
The way we start with the podcast is we go back and we talk about your initial spark, if you like, for investing and money and finance. And I found the best way to do that is to talk about perhaps your upbringing, where you come from, and any early inspirations in finance.
Well, yeah, I mean, my family wasn't really into savings or investing or anything like that. I mean, I grew up in Asia, so I was born in Hong Kong and then lived there and in Malaysia and Singapore until probably the age of 14. My dad's Canadian, my mum's Chinese. And we never really, savings and investing was never really discussed when I was younger. And I look back at it now and I sort of think, my parents haven't really saved much through their life. And we had a good life. I mean, it was a middle-class lifestyle, but never really owned anything, never owned any property, never owned any shares, nothing to do with finance. So I didn't get any of that from there. I just realized when I grew up later, after going to uni and that sort of thing, was that, and I wish sort of in some sense that somebody had told me when I was younger, the power of compounding really can really grow. And so I came to saving and investing probably relatively late in life. I went in my undergrad, I was a computer engineering. Why did I choose that? Because I was interested in computer science. I did really well in school at physics and maths, and it just seemed like a good thing to do. Graduated from that, worked 2 years in engineering, and thought, oh, this isn't for me. So I thought, well, I didn't know what I wanted to do, so I thought, well, what sort of degree do you get when you don't know what you want to do? Let's get an MBA. And then the good thing with an MBA is that it gives you skills across a breadth of disciplines, and then from there you can sort of decide what you want to do. And then again, I applied for an MBA. I did really well on the GMAT, so I got in, which is an entrance exam sort of thing for MBA schools across the US, and I got into Yale University, got my MBA there, and that's where I sort of really got interested in finance.
We spoke off air a bit about this, but perhaps you can flesh out your experience at Yale and some of the things you might remember about the classes.
Yeah, I mean, I don't know how it really compares to other MBA schools, having not been there. I'd imagine they've got quite a lot in common. But the really good thing about Yale was that your professors were the ones who wrote the textbook. They would have, every Friday, we'd have people from industry come in, and you'd have the likes of the CEO of Sony would come from Japan and give us a talk, and then you'd have a few drinks with him afterwards. One of the professors was James Tobin, who's a Nobel laureate in economics. You'd have a class with him. So that sort of thing, and then also the connection with people that you have there is really, really, really good. So I suppose that'd be the difference. But then, so I really got interested in finance there. One of my professors was John Ingersoll, who wrote one of the options textbooks. So given I had a math background, I sort of went with that pretty seamlessly. And then some other courses in investing, that sort of thing. It's interesting looking back because back in those days, when we're talking early 90s here, everything was really efficient market hypothesis. So everything was, even one of the guy who wrote Random Walk Down Wall Street, from memory, might have come from Yale, I can't remember. It was very much, there's no point picking stocks because the market's efficient. Here's how you calculate the efficient frontier. Here's, all those sorts of things, CAPM. And that was sort of my initial background into it.
So it's interesting that you mentioned options because I believe you still use them today.
Yep.
Do you think, you said the maths background, that technical understanding, do you think that, we're jumping ahead a bit here, but the options are something that perhaps someone without a maths background should be attempting to use?
Yeah, it depends how you use it. So, I worked after I worked in investment banking for 18 years sort of thing on trading desks. And we would run derivatives books, exotic option books. And for that sort of thing where you're trading volatility and you're trading gamma and all the Greeks, and then it does make a difference. But the way I use options now is not like that. I use them for hedging purposes. I use them to express a view. You don't, obviously it all helps, but you don't need to go into how Black-Scholes works, which I did before. So I don't do any of that anymore.
Okay. Well, we'll get to a bit more of that in a moment, but perhaps for listeners and for my benefit, you can talk to us about maybe your first job after Yale.
Yeah, so I got a job with Dresdner Bank. So at the time, they were number 2 German bank behind Deutsche and ahead of Commerzbank. And I started as a quantitative analyst. So I would do things like pricing up yield curves, bonds, like which bonds are cheap and expensive, or pricing models for traders to use. I did that for a couple of years here in Sydney and also in Paris. They sent me to Paris. Just an aside, I met my wife there in Aussie.
Oh, great.
All the way to Paris. Aussie girl, yeah. But so I did that for a couple of years. And then I wanted to join the trading side. I started off in currency options. We ran an Aussie book here. And then I did precious metals options with Dresdner as well. So I was with them for about 5.5 years. And then I went to Tokyo with Credit Suisse. At the time, they were Credit Suisse Financial Products, who were one of the innovators with how to price swaps, anyway, probably a bit left field. But so I did, I did precious metals options with them. We ran an exotic options book. It was probably one of the biggest hedging books in the world, us and JP Morgan Chase, and certainly the most exotic. So we would do things for miners, predominantly quite a few Aussie mining clients back in the days, like Newcrest, you name it, whoever the Aussie and US and all the gold miners were. We would hedge their gold price risk for them.
Right. Okay.
So when they produce gold, they would sell. You could sell gold forward, or they could do with option structures around that, and take some of the price risk away from them, and we would manage that risk, and obviously charge them for the privilege.
Yeah, so for listeners' benefit, the miners are obviously producing gold.
Yep.
And they like the suppose, the assuredness that you can write a contract and secure a price for that for that particular commodity that they're producing.
Mm-hmm.
Okay, and was this your time at Credit Suisse? Was this in the lead up to the GFC?
No, so I was with them from 98 to 2003.
Oh, sorry, earlier, the .com boom and bust.
Yep. So I remember, because I didn't really trade equity. I didn't really buy equities for myself. So if you go by like the first trade I did for myself, I was just one of the quant guys, and I went up to the options desk. In those days, compliance and everything was very different from what it is now. But I went up to the options desk and I had a view on dollar yen, so I said I want to buy dollar yen. I can't even remember if it was a call or a put at the time. And I did the same with dollar mark, and made pretty good money in 2 weeks, that sort of thing.
Right.
And think, well, this thing's easy, which it isn't. And then I remember in the .com room, half the floor in the trading room. This was at Dresdner. Would be trading tech stocks for themselves. So they
just
do their job just on their personal account. And I couldn't do it, but maybe I should have. I don't know.
At least for a time, we should have.
Yeah.
Okay, so now we're going to skip forward a bit to around about 2004.
Mm-hmm.
And you take a job at Mitsui, is that right?
Yeah, so I was with Credit Suisse till 2003 here and mostly in London.
Okay.
And then if things had been different, I probably would have stayed in London. But my wife is Aussie, wanted to come back to Oz. So we came back to Oz. I worked for Mitsui for just under a year. Again, in the precious metals world, providing hedging for Aussie producers. And Mitsui were one of the Japanese conglomerates. The way they structured everything was different companies. So there's a Mitsui Precious Metals. There's basically a company for every bit. There's one for base metals. There's whatever. And I was with them for a year, and then ABN AMRO for the last 5 years of my time in investment banking.
Okay, so it seems like you've had some world experiences. You've been all around the world for work.
Yep.
Do you think finance is a good job or industry to be in?
It depends on your personality. So to me at the time, I loved my job. So it was like I'm getting paid to sit with a bunch of guys, having fun. I mean, obviously we worked really hard, but having fun and you're trading big books in the market. Sometimes at some stages, I was the biggest book in the market, and it was really fun. Towards the end of it, though, I think the industry sort of changed, and it wasn't so much fun anymore. Compliance is a good thing, but compliance became more and more and more of a burden. They cut back people, so the number of people doing the jobs was cut back further and further and further. So whoever's left is basically doing the job of more, a number of people, and it's a lot harder to do what you want to do. And in the last job I was at ABN AMRO, it was through the GFC, and things changed in the GFC as well. I remember being at the coalface of the GFC, and so I've talked to other investors and saying how they were buying lots in the GFC, and I think being so close to it and seeing how close the financial markets came to almost meltdown was really quite an experience. So if you go back, I had started buying equities for myself before. My first equity purchase was Qantas in the IPO, and then I sold it when Alan Greenspan came on and said, "This is irrational exuberance in the market," and that was my own. So basically, I didn't know what I was doing.
Sounds like a pretty good time to get out.
Yeah. And in the GFC, so I had some of my own shares, and I had some managed funds, and I had a margin loan because that's the thing you did. And in the middle of the GFC, everything's falling around you. You can see the bank you're working at doesn't want to deal with the next bank because we're afraid that they're going to go under. So you can see all this stuff happening, and almost in a way you're too close to it to take a bigger picture view. So, and it's sort of, we'll come to it later in terms of what I do now, but in some way it's sort of, that experience has shaped what I'm doing now. So using leverage, for example, I don't do that because, having a margin loan in the GFC and everything's going down is not comfortable. I'm lucky I managed to pay it off. And also the other thing is managed funds versus direct equities. I had confidence in the equities I chose myself because I knew about them. I invested stuff in funds just because that's what you did, and I didn't have no confidence in them. I sold them. I can't remember where the ASX was. Maybe it was 4,000 or something, and it went down to 3,000. I looked at it, I'm a genius. Right? But did I buy any down below? No, it just came back up. It's another lesson sort of thing. Yeah.
So you were at the coalface. There's almost chaos around you.
Yep.
Do you think there were, looking back on it now, do you think perhaps there were some maybe behavioural nudges you could have given yourself in advance? So things like a rules-based strategy or something like that?
So I do that kind of now. So if we talk about what I do now, I sort of do things almost in a way to hack myself. So basically that's why I run a large cash position. That's why I do hedging. And I think in some sense it's almost knowing in advance and being prepared in advance for, because not every day is going to be sunshine and roses. That's why I run things the way I do. And I have gotten more near to it over time. But also part of that is because I have a high cash position. It's because I have some hedging in place that, I can look at it a bit more dispassionately. And also when I look back, not everything was bad because I bought Apple shares back then, right? And Apple got creamed, but because that's another lesson, is that because when you know what you buy, you'll have confidence in it to hold on and to, it's more than 20 bags since then, I think 23 bags or something since then, and I've added on the way up. But like with the Qantas shares that I bought, I just bought them because somebody said it was good. So those sorts of things. If you're buying because it's somebody's told you, or you got a tip, or you don't have confidence, or you're not going to hold on, and you're not going to make rational decisions. So I sold all my managed shares because I didn't know what but the stuff I bought myself was the stuff I kept and added to. So I guess that's one lesson that I've sort of drew from that.
Yeah, I think that's a really important point. And I suppose our role as advisors is to give people ideas and make recommendations, but it's also paramount to educate people and for them to understand for themselves, because we all think we'll act rationally or we'll do the right thing, and hindsight's a wonderful thing, but definitely, and it's we've talked about it in this series before about the circle of competence and knowing your limitations too.
Yep,
both really important. Okay, so let's jump forward a little bit. DVO funds, 001 funds, is that right? Can you explain, because it was a new name to me, what the company and the funds management company was and what you did?
A hedge fund. A friend of mine, an ex-colleague from Credit Suisse, had started it.
Okay.
And I'd invested it in him while I was at ABN AMRO through the GFC. And then when I left ABN AMRO, I joined him. So there were two of us running it. And what we were trying to do was basically commodity focused. So both of our backgrounds were in commodities. And the problem with commodities is that, and I think even Warren Buffett himself has said that, is that it's very hard to apply a value investing approach to it, because your underlying product just is a commodity and the price goes up and down. So what we try to do was say, okay, look, we can hopefully, if we're good enough, we can identify good mines. We can analyze that. We can identify good management. We can't control, like, say for example, it's a gold company. We can't control the gold price. So why don't we hedge out that part? We know how to do hedging. So we can do the value investing approach to picking the good company, picking good management, and by hedging out the commodity price risk, we're not exposed to that, and that'll give us a good risk-adjusted return. And we did this across the commodity suite, from like precious metals, base metals, energy, iron ore, that sort of thing. And so the typical thing we would do is, for example, we would buy shares in, I'm just picking up, any randomly, we would buy shares in Newcrest, and we would sell gold, that sort of thing. So I did that for 2.5 years. It's quite complicated. So we got decent returns, but it was almost like you're running 100 miles an hour to get these returns. And risk adjusted, they were decent. But what you do is that say you get a 10% return. some people say, well, I just invested in the ASX and the ASX just returned 20 this last month. And you sort of explain, well, I've hedged this, that. But it
doesn't matter.
Doesn't matter.
Yeah.
Right. So we sort of wound that up. I left it when our biggest investor was another fund. And that fund withdrew money because on a separate note, they got investigated by ASIC. They had to say, well, what investments do you, ASIC wound them up and say, well, what investments do you have? Oh, this one's liquid, we'll sell that one. And the other thing that I learned from those days is that compliance is a huge issue. So we spent so much time on compliance. I remember 1 month doing nothing but compliance, just coming up with a know your client and program so that ASIC could come in and say, oh, yep, tick the box. So it's quite hard so we ran about 25 million. To my mind, you sort of, these days you need at least 100 million before you sort of jump the hurdle of the compliance box.
Yeah, it seems to be only going one way, the compliance hurdle. I know firsthand.
Yeah.
Okay, so let's talk now about Norse Capital.
Yep.
Why did you name it Norse Capital?
So my background on my dad's side is Norwegian, so Norwegian Canadian.
Yep.
So, and 4 letters is short, so when you're filling out forms, it's easier to do than some long one. So why not?
Why not? Okay.
I like Norse mythology when I was a kid too.
Oh, right. Okay. So can you give us describe it, why you went down this path that you did, how you funded it, all the details.
Yep. So it was sort of born out after I left the EVO1 and got anti-compliance or jaded compliance. I sort of thought, well, I want to be able to invest my own money like a family office and not really be spending my time doing compliance. And I know I'm going to invest anyway. So I set it up as a family office. I had savings from the last, 20 years of work and just started from there.
Okay. And friends and family?
Some friends and family. But so far I'm not taking any external capital.
Yeah.
Maybe it'll change in the future, but we'll see. Says hello to compliance again. Anyway.
Yeah, until that time. Okay, so what's the 30,000 foot view? What's the overview of your investment process?
Yeah, so and it's sort of grown over time, but I sort of really am looking for, I guess, what you call long-term compounders.
Yep.
And basically growth compounders. When I started investing, I really thought that I could do, I suppose a bit of my background, I thought that I could do everything by the numbers. We'll just do value investing based on these statistics and these numbers and things that are trading under cash backing and things like that, and or low PE multiples. I started out that way, thinking that numbers are everything. And over time, I sort of realized that where have I actually been making? Where do you actually make money? There's nothing wrong with doing that kind of, like, I bought some stuff at list and cash backing, but the amount of time you spend on those, and then you're flipping them over, and then you go to research again. Whereas I remember a couple of studies that really resonated with me were one was I think it was anyway, it's a study on the S&P 500 saying what returns are. And if everybody throws out there's this 10% per annum return, or Aussie shares or US shares, whatever. But when you look at it, most of that return is made out of a skew of these guys on the right-hand side of the skew that have done really well, compounded and grown, multi-bagged over time, and a whole bunch of everybody else.
Yep.
Right. And there's another study that sort of backed that up. I think it was the Fidelity one, where they looked back and said, who are their best customers been over the last how many decades? And it turns out the ones who were inactive, i.e. mostly were dead. They didn't touch their accounts. And why? Because they let it compound. Whereas if I go back to that bit in the GFC, if you're short-term focused and you're seeing that stuff happening around you, you're not letting things compound. So I guess through all those experiences, I guess what I'm trying to do is find companies that basically will compound, and I can hopefully stay with them for long periods of time, and they'll keep growing and keep growing. And they'll more than outweigh because the losers. Because if you get those ones right, you don't have to have a very high hit rate. You just have to have a few of them, and they'll outweigh all your losers. So, and if I look back on the portfolio, that's the ones that have really made the vast majority of all the returns.
You wrote recently, "Let your winners keep winning."
Yes, and add to them as well.
Yeah. You mentioned Apple.
Yeah.
Can you provide any other examples?
Yeah, so Apple was one I bought early on an adjusted price would be below $10. It was $9 something.
Wow.
And so it's pre-split, whatever. So post-split, it's that. And I actually added as it went up. So this is the real key. So I don't put a huge amount in one place, in one one equity at a time, but I put some in. I was confident with it, and I got confident, and it proved the thesis. I add more, and that had more than 10 bagged. And the idiot in me, back whenever it was, I didn't follow my mantra to try and let things grow. I thought, oh, okay, it's become the biggest market cap company in the world. iPhone, it's a hardware company. I didn't look beyond how can they pivot. I sold half of it, and that was between $90 and $120. Now we're $100 higher, right? So in a way, almost the biggest losers have been selling too early. I mean, there's other ones. There's another example that I bought Altium at a low price. I can't remember what it was, $2 or something, and added on the way up. And when it got to, I think, about $13.50. The first time it was $9, just shy of $10. I sold all out of it because I said, well, based on my valuation, it's gone up. It's too high. Came back to the sevens. I bought them all back. Thought I'm a genius. Did the same at $13.50. Of course, it didn't go down. Now it's 20 something bucks. Right. So those are lessons. But if I look at the portfolio, every single one of the ones in the top 5 are all multi-baggers, and they're there because I left them there and let them grow and added when they did well. I mean, there's obviously going to be some that you sell along the way, or if your portfolio weighting's too high, you sell. But like Apple's over a 20 bagger. My biggest position now is Appen, which has now come back to a 7 bagger. Pro Medicus of a 9 bagger. Even Amazon, 5.5 bags. It's not that I was a genius at picking them, but it's that I let them run and add when they go higher, which is psychologically sometimes difficult to do. But
you're watering your flowers, not your weeds.
Yes, although I have been known to cut some flowers before.
But you don't need. That's right. You don't need many of them to make a serious amount of money over a long period of time. Yeah. Reading your updates, I can see that a large part of the portfolio is invested in Australian small caps or smaller companies, and then you get the exposure overseas to some Apples, for example, the mega caps, if you like. Can you describe why you like the small caps? Yeah, so a couple of things. I guess one in terms of growth, that you theoretically you're getting in early. You can see the story as it's unfolding. Also, I think it's small caps aren't as followed by the market. So, if you do your research and you're not competing against a whole bunch of analysts who, like, I don't know how many analysts there are covering BHP or NAB. There's potentially none. So you're looking at that. Some studies have shown as well that small caps have outperformed in the long run by a few percentage points. And it's interesting as well, small cap growth and small cap value have both done very well. And small cap growth has done, in one sense, hasn't done quite as well as small cap value. Actually, maybe the numbers updated now might be different, but at one point they lag small cap value, but that's because when it reaches a certain size, it gets cut out of that index. Whereas if you keep following them, once they're no longer small cap, well, then that's how you get small cap become mega cap. And you've got the ability to follow them from being a small company to a mid cap to potentially a large cap. That's hopefully that's what you theory. Get. Yeah. How about your investments abroad? Do you think some investors are missing the boat, particularly Australian investors, with that home country bias? Yeah, I think definitely, because obviously just from a numbers point of view, the ASX, I think, represents something like 2% of the global market cap weighting. But not only that, the ASX is huge weightings to banks, resource companies. There's not that, on a weighting point of view, there's not that many technology stocks or stocks that give you exposure to, or medical device stocks or
biotech, things that are really changing the world as we know it. And there's some great Aussie and Kiwi companies that are, but you don't want to just limit yourself to our little corner of this little branch on the end of the tree. You invest locally, but also invest globally. Now, I just do it with US because it's easier for me. In theory, you should, don't just stop there.
Yeah, I mean, from my perspective, sure, you've got to, if I'm a retail investor or a mum and dad investor, you've got to fill out a few extra forms, and it might seem a little bit more complicated, but if you just do reading and you understand what you're doing, it makes a whole heap of sense in my view. And you make the point about the banks. If you own a property in Australia, your job might be linked to construction.
You're ready to have exposure.
Yeah, you don't need that. You don't need your superannuation fund probably has exposure to the banks as well. You probably don't need that extra exposure in your own personal name. So you're a single man outfit nowadays. How do you find new ideas?
Yeah, so a number of ways. I do screens. So I don't know if you know Joel Greenblatt's Magic Formula. So he's one of the guys. I really like his books. At least every month I'll run a screen on the ASX and use his Magic Formula and tweak it a bit for momentum and that sort of thing, and just to have a look. Or sometimes I'll just go through manually one by one a few ideas I've just found let's just rank everything in terms of some multiple EV, EBITDA, and let's just go A to B to C. I've done that, which can be a bit boring, but things you do. In addition to that, I work in an office with 5 other guys who have a similar sort of background and are managing funds, and so we bounce ideas off each other. I just read a lot and listen to podcasts a lot as well.
Oh, great.
Divide the podcast up. A third of the podcasts I listen to are probably investing, a third are rugby, and what's the other third? Just politics or astronomy, that sort of thing.
Just to break it up a bit.
Yeah, just to break it up.
Yeah, great. Okay, so I've read before that some of the things you look for, high quality management and tailwinds.
Yep.
Can you maybe flesh them out a bit? Let's start with management, and I suppose why that's important, but also from something for the listeners to take away, how you assess management.
Yeah, I think especially with small caps, management is really important. Problem is that it's not so easy to tell how good they are. So I have met management at quite a few companies, and maybe it's my personality. I believe people, and sometimes you drink the Kool-Aid, and they don't. They just tell you what you want to hear. So it's nothing. It's not easy. It's more of a qualitative thing. But one thing I do find is that you can cut through a lot of that if they own a decent chunk of the shares. And I mean, you'll see some who are gifted it, and it's find out how they got their shares. But that's one thing I use. But it is very important. And if I look at some of my losers in small cap land, in hindsight, you can go back and point, well, management's a red flag. But I don't think there's any easy, from my point of view, no easy answers in how you tell. But there's general things. Are they wasting shareholder capital? Are they just gifting themselves shares left, right, and center, or that sort of thing? But
well, that makes sense. Some listeners probably don't have the time or the ability to go out and speak with management, but like you said, there's one telltale sign there. Skin in the game. But
I mean, even speaking with management, you can get fooled the other way. So it's happened to me before. So
it's happened to us all, I think, if you've been in it long enough, in the game long enough. So how about tailwinds? What are you looking for?
So tailwinds, I basically, when I look at a company, I'll have a checklist, and things like tailwinds will be different industries will show up. So if your industry is going well, and then you can see. So there will be industry tailwinds, but also on company-specific levels, like some of the things on my checklist are, how fast has revenue been growing? For how long? And things like that. What sort of sectors are they in? Is the sector growing? So those tailwinds for me, if you get the industry right, then you're already halfway there. Then you get the companies right. Is the rest of the story. So I'm cognizant of the fact that in the portfolio we have quite a big exposure to technology, for example.
Mm.
So that's not an accident, because I view in the long term, if I look out 3 to 5 years, I have to be confident that the growth is there. Even if I get the valuation wrong, the growth will still be there and will pull me out at the other end.
Mm. You touched on it there and earlier on when you said the valuation of Altium. Twofold question: how much emphasis do you place on valuation, and how do you typically arrive at valuation?
So in the beginning, I put basically almost everything on valuation. But as I've gone by, one, valuation is more an art than a science.
Mm.
Sure, the spreadsheet part is all going through. So I'll do discounted cash flows. I'll look at multiples, that sort of thing. But nobody can look at you in the eye and say, well, I value Appen at $12.78. All that means is I went in my spreadsheet and I said, okay, what have I got for the terminal growth, and what have I assumed for this, that, and the other. So I do use discounted cash flows. I try and get a range, but I also try and look at it probabilistically and say, okay, how confident I am with this, and get a range out of it. But I've also learned through experience that I won't really just sell on valuation. I have in the past, and I probably will still do it, but I also am more likely to trim and say, okay, portfolio weighting is this, valuation is this, why don't we take some off? But I've learned the hard way that, if you have a good company, you try and stay in. And that's what I do with some of the other things I do in the portfolio to help me stay in these positions longer.
Mm. So people get cold feet, or, you might be successful and an investment goes up 50%, 100% if you're even, I suppose, more astute or lucky, however you want to frame it. How do you think about, you see these names up so much, Apple shares are up so much. How do you think about protecting that? You use an option strategy now.
Yep.
Perhaps you can explain how you do it, because I thought that was kind of unique.
Well, first and foremost, you still have to have, regardless of what your hedging strategy is, you still have to have confidence in each individual investment. Mm. So like if I look at Apple, it's gone up a lot, but its forward PE is, I don't know, something like current price maybe is under 17, it's 16.5, something like that, in line with the rest of the S&P 500. It's been growing services 31%. It's had 4 quarters in a row of double-digit growth. So, and yet it's still at that sort of PE. And in one sense, you look at it and you go, okay, it's a hardware company. It deserves a lower PE, but it's getting services approaching 20%. So based on that, deserves a higher multiple. So each and every individual company you still have to believe in. And if I look at the top 5 things in my holdings, all of them are profit-making. Mm. All of them like even Appen, the number one hold, has, I think that I'm just using PEs because it's easy to talk about, but it's got a PE of 30, but it had growth of over 100%, organic growth of over 50%. So look at it on a PE growth basis, it's less than 1. So my biggest weightings will be that. Then there'll be things smaller, lower down the other end of the scale in terms of portfolio weighting will be more speculative stuff or things that aren't profitable yet. Mm-hmm. But I won't give them a huge weighting in the portfolio. So now to get back to your question on hedging. Mm. So why do I hedge? Well, a few things. One's behavioral. We mentioned this before. I have a high cash weighting. As the market goes up, that cash weighting automatically becomes a smaller percentage. Mm-hmm. And then so that entices me to, if I want the cash weighting to say neutral, then I'll sell some. If it goes down, cash weighting becomes bigger, it entices me to buy some, all else being equal. Mm. And again, with the hedging, basically what that's trying to do is basically, it's not that I won't lose money on the way down unless I go and hedge the whole portfolio, it's way too expensive. But what that does is it says, okay, as the market goes down, if the market's going down just because the market's going down, PE multiples compress, or the mood has changed, the underlying businesses of the companies we invested in, unless they've changed, are hopefully still there. So if you still believe in those, you still want to hold on, because you can still see in 3 to 5 years' time, these will be companies that will be, will grow and more than outlast their current valuations. But in the short term, if I have some market hedges in place, well, basically what I'm doing, this enables me to stay in these, hopefully enables me to stay in them longer, because I'm not getting whipped around just because the market's getting whipped around. I'm not pretending that I can time the market. I don't have a crystal ball, but especially these days, I'm sort of building up the short positions and the hedges and the cash waiting, just because I think valuation-wise, the market's probably in the later stages, but it could still keep going up for another 2 or 3 years, and who knows? I can't time it, but if I'm hedging and if I'm identifying some shorts, then I'll be able to stay in my conviction positions longer.
When you say shorts,
yeah,
what are you referring to? Specific shares that you're shorting?
Yeah, so I do a combination. I'll do index hedges, so like the ASX 200. In the US, I use SPY and Triple Q ETFs. So one's basically an ETF for the S&P 500, one's an ETF for the NASDAQ Top 100, and then obviously there's the ASX 200 indices. So I'll either short them, or I'll also do put option strategies on them, and I'll also short some individual shares. I try and find shares that I think are poor quality, or have a catalyst on the downside. Having said that, if I look at my hedges and cash weighting and shorts, I would have been better off in the beginning just being fully invested and just leave it like that, because performance-wise, knock on wood, we've done quite well, but I could have grossed the 18% up to 24%, and I spend probably 2% per year in hedging. That would be 26%, right? But I am also conscious that we've been in a bull market this whole time. The story might not be different that way, but also behaviorally, even though this has so far cost me money, what it does do is when things go down, I'm more inclined to look for things and buy, as opposed to being frightened out of my position or that sort of thing. So I've basically know yourself in advance, design things so that I can continue on with the strategy I've set.
So how do you think about, or not how do you think about, how do you track the performance of the portfolio? Do you use software or?
No, so I do it myself. I basically have a spreadsheet. I do everything in spreadsheets. Maybe it's my background in computing and using spreadsheets for the last couple of decades. So I do everything in spreadsheets, and I calculate everything myself.
Do you think that that tracking the performance has allowed you to iterate and make better decisions over time?
I think so. I think even so, the reason why I started the website, I promised a mate of mine who I've also helped in investing that I would do a website, and I said, well, okay, look, if I'm still doing this after 5 years, I'll do it. So I did it.
Where can listeners find out more about you?
norsecapital.com.au, and I also have a Twitter feed if you're interested, Norse_capital.
Yep, there's a newsletter they can subscribe to.
Yeah, that's on the website if you want to. You can put in your email address and click subscribe.
Great. Okay, final question, Curtis. My favourite. If you could go back in time and tell a younger you one thing about finance, investing, or money, what would it be?
I think it's an easy one. I probably can't remember if I touched on it earlier, but just start early, because compounding really makes a huge difference. My family was never really into that, and I only started late, but just start investing. I remember even when I was living in the States and other people were investing, and the share markets just kept going up and up, and I'm too late. And I sort of hesitated, and just there's no perfect time to start. Just start.
Great, wonderful advice. Thanks for your time, Curtis.
Thanks for that. Cheers, Owen.
Hey everyone, I hope you enjoyed this episode with Curtis Larson. Please remember that we're hosting our very first investors event in Melbourne this month. It's open to investors of all stripes and experience, but there are limited tickets. So come meet me, Andrew, other guests, and investors to start building your investing network today. Head to the Rask Finance website to reserve a seat for you and a friend. I look forward to meeting you in person.